Good morning, traders and investors. Welcome to this Monday, April 10th edition of Pre-Market Prep with StockOdds. Joel Elconin back with Rob Friesen here on the saddle on this Monday morning. Futures, I'll run them down real quick. We're in the red, turned around, get eroding Friday's gains. Now, we're banging on the door of last week's low, but we're still holding up. So that's a big number. We're down 24 and a half handles, 4107.50. Strong day for the buck. That's not good for the markets. That's up 73 and a half cents, 102.46 and a half. The bonds, man, that 134 is like kryptonite. We're back down at 132.10. Crude remaining in the $88 handle, down 34 cents. Gold peeling back, trying to stay above 2K, down 22.90 at 2003.50. Silver under 25 bucks, down 9.8 cents at 24.95. 995, and Bitcoin up $410 at 28,455. I'm going to stop the screen share. Rob's got a good topic for us today, and directional trading and long short markets. Rob, what do you got for us?
Well, before we get into that, first, just want to point out the equities market was closed on Friday, as you guys know.
Yep.
We had the jobs number come out, and that moved treasuries only slightly because they were still trading for a bit on Friday. But the impact of that number is what you're seeing reflected in the downward move of the bonds, and basically yields rising, and the US dollar, obviously corresponding to potential for yields to rise here over the big picture. So today's impact is directly related to the jobs number on Friday. Okay, I mean, we would have been able, if the equities had been open, we would have been able to adjust on Friday. Now, there was some speculation on Thursday's move, and I conjectured that potentially it was a leak of information or it was just speculation. It could have been either one, but the way that the market was sort of rallying there, the later half of the day, seemed to be that speculation that the jobs number would be favorable for the Fed not to be raising rates. So this is the battle that we're in, right? Are they going to stay on course with raising rates, and we know the implications of that, or are they going to be more dovish? Really, that's the battle. That factors into the inflation, deflation thing, etc. So we see a stronger dollar today. That's not going to be good for gold and the metals and some of the other basic materials. The oil seems to be a little bit insulated from that because it's more focused on the OPEC implications and the general economy. So it's not as negatively correlated to the dollar. In fact, sometimes the dollar's been strong, oil's been up, like you see today or whatever, right? So, okay, keeping that in mind, let's share the screen here on my side. Get into a couple things that we proposed. So first thing I'm showing here when it comes up is just the daily chart of the SPY. I have a black line on there, and that was Monday, April 3rd open. So I'm rolling back a week to, show a lesson here. So we produce, these 5-day swing trades, and the theme that I'm going to show can be applied to whether you're trading a single pair, a portfolio of pairs, long short baskets, intraday, swing trading baskets. It's all the same complication or opportunity. It's the same problem or opportunity. And that is, some days you get like an inside day, really tight, not doing anything, and you're not going to have that much opportunity to trend trade or get the reversals and things like that, right? In fact, if you try too hard, what happens, Joel, when people try to make something happen when there's nothing going on, when they try to capture all the reversals when there's really nothing, they get whipsawed, right? And that's never any fun. So we want to avoid that. So we have to recognize the construct of the day. You have to be able to determine whether the odds are for an inside day or an expanded trading range session. Expanded trading range sessions where you're pushing into filling a daily gap or something can be really good directionally. Or you've been down in a hole after 4, 5, 6 down days in a row, and now you're reversing and you've got plenty of blue sky to trend into. So those are very different days than your choppy inside day. So here's where we're at right now. And that was April 3rd open. And so, on that deployment of capital from April 3rd to April 6th, there was a shortened week. These are the symbols that were on the docket for the 5-day. And just focus on the top ones here. These were secondary stocks. So these are the primary ones. So during that week, only Myrna sort of hit a swing target. So the swing target is based on the weekly high and low from the previous week, where it opens, and that quantity, if you divide that in half, added to the opening price. So this is the number of points potentially, and there's a target. So Myrna hit the target on day one. Okay, so if you're looking at things from a annualized return perspective, if you have targets that are hit, like if you put on a swing trade basket, Joel, you've got 3 ideas long, 3 ideas short, and they're for a week. You want to get a really good bang for your buck for the week. And right away on day one, you get targets being hit.
What do you do?
By thinking about taking that profit, though, if you can lock that in, or definitely put a protective stop or something on it, think about that profit return without all the subsequent risks and so on of holding it the remaining days, right? So there is a good argument for if something pays off very quickly, no different than we put a basket on, open the close, and at half an hour into the day, which is often the case, you get a peak spike of profit, and you don't know if that's going to continue or to fade. So let's say outlier conditions on open to close baskets are 1% return. Okay, that's normally we're in the 0.2 to 0.4 on a good day, and sometimes 0.6, 0.7. But let's say it's just 1%. That's a big return. If that happened in 30 minutes, would you not be inclined to lock the profit? Because it's, first of all, an outlier. Secondly, you've got the remainder of the day where things can happen, things can reverse. So I think people understand that concept pretty well. If you're just trading from open to close and you get some big bang for your buck early on, you're probably inclined to protect it. That protection can start by doing one symbol at a time, or if the market had contributed to that, the market move, let's say the market had really ripped up, and for some reason your long side was just very correlated to that market move, and your shorts were lagging, so you're getting great payoff, and then the market kind of hits a number and starts to roll over. There's the potential that the gains that you made are going to decline somewhat. So in doing that, if you see the market rolling, the first thing that you would want to sell would be your long side. And you might want to slide out of it on the short side, meaning as the market pulled back, your shorts are still going to decline with the market. Then you're using the market to get out of your basket. You do the long side first, and then you do the short side. What's the risk, Joel? If you take all the longs off after that rally, and now you're only holding the shorts. So let's say you highlight your longs and you just mark it out of them, and boom, now you only got your shorts. So you got to be right. You have to be more right.
Exactly.
Right. And so that's always the tension. When we talk about using the market, that's always the tension. Okay. So the first thing is, are you able to address things on an individual basis like this Myrna? Okay. And especially if that's early on in your day or early on in your swing trade, multiple days. Now, look at these numbers down here. Most of the short side hit their targets. So day 2, day 3, day 4, those targets were hit, and some of them exceeded. So this is the problem on any given day. If we're having some significant movement in the markets, you're going to have, either on the upside, maybe more of your longs are going to hit their targets, or on the downside, maybe more of your shorts are going to hit. So it's very unbalanced. It's not completely symmetrical. If the markets were just to stay flat and choppy and sideways, you might have some of your longs hit their targets, some of your shorts hit their targets, and it's much more even and balanced. And so then you're just taking that singular approach of addressing each stock, maybe locking the profit and replacing it with another symbol that you can keep this sort of rolling swing trade going. Intraday, same thing. You could take one off and replace it with another symbol. The symbol choices could be other stocks that you feel are advantaged, or could be the sector ETF that you might be exposed to more, or the sector ETF that replaces that symbol, or just use the SPY or the Qs or the diamonds or the Russell, depending on your exposure. So you have choices, okay? But I find that what tends to happen with traders is they'll see something like this. And again, this could represent just your intraday baskets, but you have the same problem. And that is all of the shorts are, highly profitable, and the longs are underwater. Okay. And you're still doing well. Or maybe the equation is you're not doing well and you want to improve things. You want to help, right? So the shorts have all hit their target and they're very profitable. Do you just take them all off and then just leave your longs? And I see traders struggling with this and also making mistakes around this. So what does this go back to, Joel? The decision-making process. Like, let's just forget that we're in baskets for a moment. Let's forget that we're in long short pairs. Let's forget if you were just a buy-side trader that was looking for a setup in the market to grab some symbols, maybe one symbol or more, that have great potential to rally on this particular day as the market swings back. What would you look to? It goes back to your indicators. What's the VIX doing? If the market's down, has the VIX risen? Right? If the market's down and the VIX hasn't risen at all, that means that portfolio managers are not, concerned that there's something behind the scenes. And you may find that therefore the base, the base or the soil of a rally is favorable. If the VIX has rallied a lot, meaning that there's a lot of concern, well, then, watch for the turn on the VIX before you get involved on the long side of your, right? You got to watch, again, what's been the contributing factors to the market? What's been the engine? Is that engine run out of gas? So today, for example, we don't have a significant move in the market, but it already kind of moved pre-market with the engine of Friday. And you saw some of your leading indicators, the bonds and the currencies, move appropriately. So that engine would have to be sputtering and running out of gas to give us, the traction and the rally potential for today. I mean, we may go fill the gap. I don't know. But it all goes back to the indicators. So we have the VIX, we have your currency, we have your bonds, we have the breadth of the market, right? What's the breadth doing? The advancers over decliners. What sectors are leading? Are they starting to dissipate? How is the risk on versus risk off categories doing? Like, what are the consumer staples doing versus the consumer discretionary? What's your value ETFs versus your growth ETFs doing? If you just have some of these indicators on your screen, that's going to help you determine whether you should go long on an opportunity that you've been waiting for. The same rules would apply here to how aggressive you are at removing those shorts that have declined with the market and are favorable, right? And so I would start with, the ones that may have given you an outlier performance, that you want to protect that profit. And if the market reversed, you're probably going to lose some of those gains as the shorts rally back up. So I would start with those and, kind of do it incrementally. If you have a bigger catalyst that came in, all of a sudden there's new information, some talking head, the Fed speak, whatever it is that's going on, and we have a catalyst suddenly coming in, then it would be more of a case for a highlight all your shorts and cover all and let your longs rally back. But you never do that without really solid information and something is changing that has enough power to propel it. One more thing, if you're ever going to decouple like that, load up one of your order entry windows with a market ETF like the SPY, or if you don't want exposure to the FANGs, for example, use the RSP, which is more broad-based, more mid-cap exposure than the FANGs, and load that up to be able to do with one click, hedge off everything that you just took off. Okay, you have to be ready for that. If you're going to pull a side, okay, you're going to decouple it, so you're only long. You better have loaded up the SPY or the RSP, or if you're exposed to the NASDAQ more, the Qs. You could also use the inverse, like you could buy SDS or you could buy SQQQ for the NASDAQ. So with one click, it's easy to bang, put on the appropriate amount of capital. That will help you with the confidence to stay with something, even if it's kind of like a bit shaky, a bit noisy, but you're seeing the indicators, so you're trusting in your indicators. But you got to get loaded up. And if there's a problem, just hedge off. So with regular trading, we might say, when in doubt, get out. With hedge trading, when in doubt, hedge off. And that will allow you to push yourself back, look at the big picture, sort of be insulated to some degree. Now, granted, if your long basket that you still have on are really high beta stocks and you just hedged off with equal capital of a market ETF, if you're wrong and the market rolls over and continues to go down, you're going to probably suffer on that long side because they're going to move more than the market. So that means be standing by that if you're wrong, you're first you're hedged. Secondly, increase your hedge to compensate for the betas that you're exposed to. Okay. So these are sort of best practices. Again, if you don't need to be exposed to the market direction, all the better. But there are times where you're going to want to take advantage of market direction. And so I expect the markets to be very syncopated this year. Okay, what does that mean?
Move together.
If you look at the macro, if you look at all the stuff going on in the world, I mean, it's in some areas it's getting worse. We're not going to get into all the doom and gloom, but there's a lot of concerns globally. Okay. So I expect the market to be like, a lot of chop, a lot of, reversals, a lot of mean reversion, but occasionally you get these days where it just takes off in one direction and the signal to noise ratio is really, really smooth. And it's just one of those, everybody's buying today. Okay. And if you have this flexibility to be able to recognize the different types of days and events, then to be able to lighten up on your short dollars and let your long dollars rip is just a bonus, or vice versa. Okay. So very syncopated markets, meaning, quick, slow, quick, in terms of occasionally we're going to get nice, solid, directional, high signal, low noise type days. But for the most part, we're probably in, distribution, chop, sideways,
noise camp. Yep.
Yeah, I think that's the nature of these markets this year. And I don't see any other evidence to support the alternative to that. I mean, we have this theme about sell in May and go away. Well, when you look at the seasonality calendar, the end of April can be quite soft. Maybe people expecting that, but then you look at May, and May does pretty well overall. So we don't know what will happen. We've seen summer rallies like we had last year, right? We had a nice summer rally. We've seen that too. So you have to be prepared for those types of opportunities. And I don't want to take that with you by just always saying, hedge. But knowing how to hedge is valuable for your career. If you decide to decouple, being prepared by having the hedge standing by and knowing what to do is very valuable. Okay.
Okay. All right. Eric says syncopated. We're getting a vocabulary lesson too. All right, guys, that's it for today. Pre-market prep with Stock Odds. We'll be back with you tomorrow morning. Everyone, have a good day.